All right, everybody take your seats and let's quiet down. Good afternoon and welcome to today's CEOs Education Day. We're going to cover a couple sections from Morningstar's investment curriculum, starting first with this module on Introduction to Financial Statements. Although the words financial statements and accounting sends cold shivers down many people's back, this is the language of business, a language investors need to know before buying stocks. I'm sure if I had your webcam on right now, I would be seeing this kind of scene.
Yeah.
Yeah, exactly. But really, once you get to know a little about this, it becomes rather intriguing. The beauty is you don't need to be a CPA to understand the basics of the three most fundamental and important financial statements: the income statement, the balance sheet, and the statement of cash flows. All three of these statements are found in the firm's annual report, the 10K, and also the quarterly reports, the 10Qs. The financial statements are windows into a company's performance and health. We'll provide a very basic overview today and then go into much greater detail, goody-goody, in lessons 301 through 303. So today we are doing the freshman level of financial statements, and it seems to me that you're going to learn that accountants must only be able to count to three, as it seems like everything is either in three parts or two parts. But with that aside, let's get started. We're going to go first to the income statement. The income statement tells you how much a company has brought in, otherwise known as its revenues, how much it spent, otherwise known as its expenses, and the difference between the two, which is its profits. The income statement shows a company's revenues and expenses over a specific time frame, such as 3 months or a year. This statement contains the information you'll most often see mentioned in the press or in financial reports, figures such as total revenue, net income, or earnings per share. The income statement answers the question, how well is the company's business performing? Or in simpler terms, is it making money? A firm must be able to bring in more money than it spends or it won't be in business for very long. Firms with low expenses relative to revenues, and thus high profits relative to revenues, are particularly desirable for investment because a bigger piece of each dollar the company brings in directly benefits you as a shareholder. The revenue section is typically the simplest part of the income statement. Often there is just a single number that represents all the money a company brought in during a specific time period. Big companies sometimes break down revenues in ways that provide more information, such as geographic location or business segment. Revenues are also commonly known as sales, and because it appears as the very first line, it is also known as the top line. Although there are many types of expenses, the three most common are the cost of sales, the selling, general, and administrative, or abbreviated SG&A expense, and research and development. Cost of sales, which is also called cost of goods sold, is the expense most directly involved in creating revenue. For example, if Gap took $10 to make a shirt, which it then sold for $15, when it is sold, the cost of sales for that shirt would be $10. What it cost Gap to produce the shirt for sale. Selling, general, and administrative expenses are also commonly known as operating expenses. This category includes most other costs in running a business, including marketing, management, salaries, and technology expenses. And finally, research and development, which we're not going to spend time on today. Your cost of sales tend to vary with volume, so if you make an extra unit, then the cost will go up by a similar amount. Or your SG&A, selling, general, administrative, tend to be more fixed in nature, and if you vary your volume, you won't see as much change to the SG&A. In its simplest form, profit is equal to the revenues minus total expenses. However, there are several commonly used profit subcategories investors should be aware of. Gross profit is calculated as revenues minus cost of sales. Remember, revenues can be called sales as well. It basically shows how much money is left over to pay for overhead and hopefully provide profit to stockholders after a sale is made. Using our example of the Gap shirt before, the gross profit from the sale of the shirt would have been $5, $15 sale price minus $10 cost of sales. Operating profit is equal to revenues minus the cost of sales and SG&A. This number represents the profit a company made from its actual operations and excludes certain expenses and revenues that may not be related to its central operations. Net profit generally represents the company's profits after all expenses, including financial expenses, have been paid. This number is generally the figure people refer to when they use the word income or earnings. It can also be referred to as after-tax profit, and because of where it appears, it is the famous bottom line. Any profit line can be divided by sales and it will give you a margin, such as gross profit margin, operating profit margin, or net profit margin. Now to the balance sheet. Balance sheet, also known as the statement of financial condition, basically tells you how much a company owns or its assets, which we hope are big, and how much it owes or its liabilities, which we hope are small. The difference between what it owns and what it owes is its equity, also commonly called net assets or stockholders' equity or net worth. The balance sheet provides investors with a snapshot of a company's health as of the date provided on the financial statement. Generally, if a company has lots of assets relative to its liabilities, it's in good shape. Conversely, just as you would be cautious loaning money to a friend who is burdened with large debts, a company with a large amount of liabilities relative to assets should be scrutinized more carefully. There are two main types of assets, current assets and non-current assets. Within these two categories, there are numerous subcategories, many of which will be explained in Lesson 302. Current assets are likely to be used up or converted into cash within one business cycle, which is usually defined as 1 year. For example, the groceries at your local supermarket would be classified as current assets because apples and bananas should be sold within the next year. Non-current assets are defined by our left-brained accountant friends as, you guessed it, anything not classified as a current asset. For example, the refrigerators at your supermarket would be classified as non-current assets because it's unlikely they will be used up or converted to cash within a year. Similar to assets, there are two main categories of liabilities: current liabilities and non-current liabilities. Current liabilities are obligations the firm must pay within a year. For example, your supermarket may have bought and received $1,000 worth of eggs from a local farm, but they won't pay for them until next month. Non-current liabilities are the flip side of the non-current assets. These liabilities represent money the company owes 1 year or more in the future. For example, the grocer may borrow $1 million from a bank for a new store, which it must pay back in 5 years. Equity represents the part of the company that is owned by shareholders. Thus, it's commonly referred to as shareholders' equity. As described above, equity is equal to the total assets minus the total liabilities. Next, statement of cash flows. Statement of cash flows tells you how much cash went into a business and out of a company during a specific time frame, such as a quarter or a year. You may be going, wait, isn't that an income statement? Well, although it sounds familiar to the income statement, the difference lies in a complex concept called accrual accounting. Accrual accounting requires companies to record revenues and expenses when transactions occur, not when cash is exchanged. While that explanation seems simple enough, it's a big mess in practice, and the statement of cash flow helps investors sort it out. So as an example of this, when you go into a store and you buy something with maybe the store's credit card, well, the minute you buy, they book that sale, even though the money for that sale isn't going to come until you pay off your credit card, and that might be a month later or maybe even longer. Statement of cash flows is very important to investors because it shows how much actual cash a company has generated. The income statement, on the other hand, often includes non-cash revenues or expenses, which the statement of cash flows excludes. One of the most important traits you should seek in a potential investment is the firm's ability to generate cash. Many companies have shown profits on the income statement, but stumbled later because of insufficient cash flows. A good look at the statement of cash flows for those companies may have warned investors that rocky times were ahead. As it says, cash flow looks at real cash.
So what's the example of an expense that doesn't involve cash?
Depreciation on your assets. So companies do two kinds of depreciation, so that kind of muddies it, but they do what's called a financial depreciation. So if I build a refinery and a refinery has a 30-year useful life, then I take what's called a financial depreciation on that asset every year, but that financial depreciation is a non-cash expense.
Okay.
Because companies can generate and use cash in several different ways, the statement of cash flows is separated into three sections. Cash flows for operating activities, from investing activities, and from financing activities. The cash flows from operating activities section shows how much cash the company generated from its core business as opposed to peripheral activities such as investing or borrowing. Investors should look closely at how much cash a firm generates from its operating activities because it paints the best picture of how well the business is producing cash that ultimately will benefit you as a shareholder. The cash flows from investing activities section shows the amount of cash firms spent on investments. Investments are usually classified as either capital expenditures, money spent on items such as new equipment or anything else needed to keep the business running, or monetary investments such as the purchase or sale of money market funds or CDs. The cash flows from financing activities section includes any activities involved in transactions with the company's owners or debtors. For example, cash proceeds from new debt or dividends paid to investors would be found in this section. Free cash flow is a term you'll become very familiar with over the course of these sessions. In simple terms, it represents the amount of excess cash a company generated which can be used to enrich shareholders or invest in new opportunities for the business without hurting the existing operations. Thus, it's considered free. Although there are many methods of determining free cash flow, the most common method is taking the net cash flows provided by operating activities and subtracting capital expenditures as found in the cash flows from investing activities section. Free cash flow equals cash from operations minus capital expenditures. Whew. All right, you made it through an entire lesson about financial statements and we didn't use a single number. While we're the first to acknowledge that there are far more exciting aspects about investing in stocks than learning about accounting and financial statements, it's essential for investors to know the language of business. We also recommend you sharpen your newfound language skills by taking a good look at the more detailed discussion on financial statements in Lessons 301, 303, which we will do in the spring semester. So at this point, any questions?
Are we on the verge of making $1 million?
Yes. Absolutely.
Good. Good.
but it won't happen overnight. You know how a doctor makes $1 million investing?
No?
Well, they start with $2 million. All right, so if there aren't any questions, we're going to go into a little module I call income statement examples. And Josh should be handing out some samples that are on two other companies that we'll talk about at the end, Walmart and Amazon. And feel free to look at those as we go through. And of course, all gets fixated on one company, and so our example is Apple. I bet everybody in the room could have guessed that. All right, so here is Apple's income statement for the fiscal year which ended September of last year. So this report would be in their annual filing, which is called a 10-K. First line that I have highlighted at the top is called sales, and some companies, as we've discussed, call it revenues. This is the total amount of money that has come to the company for selling its products and services before accounting for any of the costs to produce those products. So when you buy an Apple iPad for $499, that would go directly into this line along with millions of other purchases of iPhones, iPods, iMacs, MacBook Airs, etc. Okay, and we don't have to know this information right now, but I thought you'd like to know a little bit about what makes up the $108 billion in sales that they had last year. So that was for their fiscal year, which ended September 2011. They sold $108 billion of product, and that was a 66% increase over the $65 billion they sold in 2010. All right, anybody want to guess what the largest single product was in their sales for 2011?
iPhone 4S. You got an iPhone 4S. Yes.
iPad.
iPad.
Okay, that by far the iPhone is the largest. iPhone in their sales, and this isn't just the 4S, this is all the iPhones, it was $47 billion, almost half of their total.
Did you say billion?
$47 billion is what they took in on selling iPhones in 1 year. The second product on the list is iPad, and last year they sold $20 billion worth of iPads. And I have a feeling that number has grown quite a bit more, and when we see the annual report at the end of September, I'm sure that'll be up significantly.
Do you think they'll make any money on the iPhone 5?
That could be an hour discussion by itself, so I won't go there. Going through the rest of the products real quickly, next after the iPad is laptops at $15 billion. iPods contributed $7.5 billion. Desktop, Mac desktops was $6.4 billion. Revenues from iTunes was $6.3 billion. And the final kind of catch-all, $5.2 million, was peripherals, other hardware, software, and other services. Now, you can see that we had a 66% growth from 2010 to 2011, and you might like to know where the growth came from. And the growth, as you'd expect, because they're the two big product lines, came from iPhones and iPads, and are kind of interesting. iPhones in 2010 were only $25 billion, so they grew by almost 100% to get to $47 billion. iPads were even more significant. In 2010, they sold $5 billion worth of iPads. In 2011, they sold $20 billion, which is a 300% growth, which is fairly unbelievable.
Are these numbers like through third parties like?
No, these numbers come directly out of their reports. This is not guessing. This isn't speculation. This isn't estimating. This is actual Apple reporting of their business.
These are like hard numbers from companies or stores that they sell their phone to or have it sold at.
Well, they sell their stuff in the stores.
Yeah, this is their sales, and as well we already talked about, the income statement, the sales is an accrual method, so it would be sales to their distribution channels. So if they sold to Best Buy, even if Best Buy hasn't sold it out of the inventory, they've already sold it, and they would book that sale.
Well, do you know what percentage of that, their sales is in the U.S. and how much of it's everywhere else in the world?
I don't have that right offhand, Rob. I'll find it out and bring it.
That's okay.
I do know that their largest Apple store, and maybe that's coming later, is in China and is huge. I mean, it accounts for like $20 billion worth of sales. I mean, it was phenomenal.
In one store?
One store. I mean, at that time they only had like 3 in China, but one in particular was a huge amount of their sales. What I want to back up to though is, so the iPhone went from 25 to 47 billion, so that's a 22 billion increase, and the iPad went from 5 to 20, that's a 15. So those two combined grew by 37 billion, and our whole company only grew by 43 billion. So the vast majority of their sales growth came in just those two products. The rest were significantly lower, and probably were all below the 66% level. All right. Next is cost of sales. These are the costs that are directly applicable to making a product or service. You'd expect that these costs should move pretty much in tandem with the sales. This is not all of the company's expenses. It is just those that can be identified as being directly spent to make the product. We'll see some other expenses here shortly. Notice that the cost of sales went up by less than sales. That's a good thing. We like to see that. We'll talk about that in a second. Next is the gross profit line. This does not always show up on the statement itself, but it's easy math. It's just sales less cost of sales gives you gross profit. And we can convert it to a margin or by dividing by sales. And so you can see for 2011, the gross margin percent for Apple was 40.5%, which was a percent better than the gross margin for 2010. And those are outstanding gross margins. Let's see, so when you buy that $499 iPad, Apple's gross take on it might be around $200. Now, of course, the actual gross margin is going to vary from product to product, and so my $200 is almost certainly wrong, but it gives you some average context. That takes us to operating expenses, which are the rest of normal expenses that are not directly related to just one product or service. There are two broad categories. The first is research and development, or R&D. These are broken out for a number of reasons. First, there is often special treatment for these as related to taxes. And second is to understand how much the company is spending to enable the continuing growth of their company. There is no easy answer to how much R&D is good. The percent is often similar in like companies in the same industry, but then sometimes it is not. What is important is productive R&D, and again, that is extremely tough to measure. Probably the most important thing to watch is the year-to-year trends on a given company. It should be a bit of a red flag if they are reducing this percent they spend on the future. Second category is selling, general administration, often abbreviated as SG&A, and that is what I will call it from now on. This is where you put the corporate costs, headquarter building and staff, marketing, corporate giving, etc. Both R&D and SG&A tend to be more of the fixed variety in that if your sales drop off, you may or may not be able to reduce these costs. And you can see that in this case, both of these did not go up anywhere close to this sales amount. Sales went up by 66%, R&D by 36%, and SG&A by 38%. So you can see how they don't tend to move as in the same amount as sales. Next is operating profit, which is just gross profit less operating expenses. And again, we could calculate a margin, but I'm not going to do it right now. Next, we have other income and expenses that are not part of the normal operation of the company. And as it says on the slides, they can include things like interest expense on or income from non-consolidated interest or litigation costs or awards. Apple is sitting on a huge amount of cash, and so this other income probably did include interest income. And once they recognize the earnings from winning the lawsuit with Samsung, their litigation revenues would come into this line as well. We add that line to operating profit, and we have the income before taxes, often referred to as pre-tax profit or PTP. And if we divide this number by sales, then we have a pre-tax profit margin, and I've shown that on the side there. So for 2011, it was 31.6%, which is a nice 3% improvement over 2010's pre-tax profit margin. Not very many companies enjoy such strong demand that they can enjoy picking up a 3% increase on their pre-tax margin in today's economy. Apple's truly unique. Next, we have a line for income taxes. Now, those taxes will not get settled until they have filed their taxes for that year. So this line represents what the company provisionally believes that their tax obligation will be for their earnings. It's useful to divide our taxes by our pre-tax profit to get an effective tax rate. Normally, a tax rate will not vary much from year to year, and when it does, it is worth digging into to see why it changed. And in this case for Apple, their tax rate was pretty close to the same. It actually dropped a little bit in 2011. If your tax rate's going to change, going down is the right direction.
Do taxes depend on country, or is that just an average of all of them?
Your taxes as a international company will be dependent on how much of your sales or your profit is being generated in the United States versus overseas. When we subtract our tax obligation from our pre-tax profit, we have our net profit. This is the bottom line. This is what we as shareholders get to participate in. If we divide it by sales, then we get a number that represents how much of each dollar that comes into the company is left after everything is paid for. So in the case of Apple, for every dollar they sell, they get to keep almost 24 cents. So back to our $499 iPad, they might get to keep, for the shareholders' benefit, about $120. Now again, the actual number by product is almost unknowable, as even the company may not know how to carve up the central overhead costs, such as R&D and SG&A, to spread out on all products. And again, you can see their net profit margin went up by almost 2.5%, which is very, very good. So even though that was the bottom line, there are some more numbers. Next is shares, and we're not going to go into it right now, but there will normally be two share lines. One is basic and one is diluted. Diluted is always the most conservative to use when you do your analysis. So that's what I have shown here. By the way, I forgot to point out that all the numbers in this table are in millions, not only the dollars, but in this case shares are in millions too. Shares is one line that sometimes is shown differently than the rest of the report, so be aware of that. Sometimes shares are in thousands even though everything else is in millions. So you can see that Apple has a little over 936 million shares, and that shares went up by a little over 1%. This is most likely due to option and or share grant programs to employees. which sometimes go only to key employees and sometimes they are across the whole company. As I note on the slide, it is good to research it if shares change by more than 2% per year in either direction. Does anybody know what it means if the shares go down instead of up?
Stock buyback?
That's exactly right. That means the company is buying back shares. Great, good answer. You get a gold star. And now our last line, even though it's not our bottom line, we have earnings per share. This is our net profit divided by our diluted shares. Lots of news and analysts focus on two things, sales and EPS, but trust me, although they are important, they do not tell the whole story, and we will learn later where the rest of the bodies are buried. So quickly, we have 5 lines on our income statement that are the results of doing either subtraction or, in the case of EPS, division. These are gross profit, operating profit, pre-tax profit, net profit, and EPS. We are looking for all of these items to grow at least as fast as sales and even better, faster. And in the case of Apple, woohoo, their sales were up 66%, but even better as a shareholder, the EPS was up by 83%. There are 2 numbers that we want to grow the same or even better slower than sales, and they are the cost of sales and the SG&A, and in the case of Apple, both did in fact grow slower than sales. Income taxes should grow at the same rate or even better, slower than the pre-tax profit. Again, you can see that in Apple's case, their taxes grew a little slower than their pre-tax profit. That meant their tax rate went down. R&D is the one number that you cannot unequivocally say whether growing faster or slower than sales is a good thing or not. An increase in productive R&D can lead to new products and services and new growth. Cuts to R&D will improve short-term margins, but it may mean reduced growth rates in the future. Now, just so you know, I'm not oversimplifying this. Here is the actual Apple report. So what differences in the form can people point out from what I just showed you? And since I couldn't hear all of that, I'll point out some things. But so one thing is that instead of just showing 2 years, they actually show 3 years. That's a function of the company. They can do at least 2, but more in some cases. As I mentioned, all the numbers in millions except their shares, number of shares which are in thousands. We talked about that being a possibility. It does show both basic and diluted shares. There's some slight differences in names, like instead of gross profit, they call it gross margin. Instead of income statement, they call it consolidated statement of operations. Instead of pre-tax profit, they call it income before provision for income taxes, and a few others like that. And I will warn you that when you are starting out, these slight differences in names will kind of drive you crazy, but pretty soon you'll realize kind of the differences that can be there, but that they really aren't a big deal. So don't let the names fool you. Just start kind of learning what different companies call them. But other than those small things, these are the same numbers we were just looking at. So I didn't oversimplify it. That was Apple's actual income statement. All right, now it's time for a little interaction. And Josh has handed out 2 income statements. And one is Walmart's. That's who we are going to do first. And I did elect to take a couple of things out of their statement, so I changed it slightly. I dropped out the discontinued operations and non-controlling interests because we aren't ready to talk about those things. So this is slightly altered. But the exercise here is to quickly kind of look through this, just like I did Apple's, and kind of see what jumps out at you. So I'll give you a minute or 2, and you can circle things and write down a few notes. And then I'll go through kind of the list of what I see. By the way, this was a 10K for Walmart for 2011, and they finished in January of 2011. So there actually is a newer 10K that would have been out in January of 2012. All right, let's just kind of quickly roll through these. So here's some observations I had. You guys can catch me, or if you had found some things I didn't mention. So to begin with, I noticed that my cost of sales were up more than the sales. That's the wrong direction. We don't like to see that. Just as a side or interesting, there is no R&D for Walmart. That's not a bad thing. It's just interesting. SG&A was up, but it was up less than sales, so it gets a green flag. That's a positive. My pre-tax profit was also up, and it was up by more than sales, so that's good. We like to see that. Same with my net income. As we talked about a little earlier, Walmart was obviously buying back shares. That's why their shares went down by over 5%. If we look at the pre-tax profit and income taxes, we can calculate a tax rate, and we can see it was pretty much the same between the 2 years. Actually went down just a little bit, which is the right direction. Our net profit margin went up by almost 0.5% from 3.5 to 3.9. Quite a bit of difference in net profit margin versus Apple. Walmart's operating on a 4% margin where Apple's over 20%. I would say this is a huge red flag. It's not that it's not a good thing that the earnings per share went up significantly more than cost of sales. The reason I mark it as a red flag is I'd want to know, is it truly a sustainable difference? It appears that they're doing some things like the buyback of shares that they probably can't do year after year after year. So this would be a little bit, even though it's positive, it's a little bit of a red flag for me. So how'd I do? Anybody catch anything else that I missed or want to bring up?
And you said that you circled the 12.7% just because they were buying back shares.
Yeah, because your sales went up by 3.4%, earnings per share went up almost 4 times more. A little bit of difference between your earnings per share increase and your sales is acceptable, but when it's this big of a difference, you have to understand the root causes of that, and one of the big ones obviously is in fact that they're buying back shares. And so before I start doing an analysis of Walmart and just assuming that I'm going to get a 12% growth every year because I got it the last year, I have to do some homework to try and decide what's a more realistic growth rate rather than this 12.7. So that's why it's a red flag. It's positive, but it's probably not sustainable.
What if we take the EPS and readjust it for the number of the shares sold or bought back? To normalize it with a bigger number.
Yes, and that's certainly that is an exercise you could do, is what would their growth rate have been if the shares had stayed the same year to year, and that is a very good, and it's a good question and good exercise to do.
Where does the money that they use to buy back shares get shown on this?
That's going to show up over on your statement of cash flows. It's a great question. And we aren't going to see that today, but we would see that when we get into and look deeper at some of the other statements.
So it's not acknowledged on the income statement at all?
No, it is not acknowledged on the income statement. There are lots and lots of things that are not on the income statement. As I said before, that's why you should not just settle at sales and EPS like most analysts do, but dig a lot deeper than that. But for today, we're keeping it simpler and stopping at the income statement. All right, we're going to do one more. This is Amazon. And since we've taken quite a bit of time, I'm just going to kind of roll through these. So observations. First, again, just like Walmart, my cost of sales went up faster than my sales. Again, Amazon doesn't have any research and development. So this was the year that they came out with the Kindle, and yet none of the costs of developing the Kindle could qualify as being called research and development. I think that's interesting. Their SG&A was up by more than their sales. Again, that's a red flag. Their pre-tax profit was up less than sales. Red flag. as was their net income was also up less. Unlike Walmart, Amazon was actually issuing shares, so that, and most likely stock options for their key employees. When we look at their tax rate actually went up last year from 21.8 in 2009 to 23.5. Their net profit margin, instead of going up like Walmart's, actually went down by almost 0.5%. And again, it's interesting to notice that they are in the same region as Walmart, but significantly lower than Apple. And the bottom line is, in the case of Amazon, we get a red flag on our EPS because we just aren't pushing our really nice, excellent sales growth through to our EPS. We're leaving a lot behind between cost for SG&A, between issuing shares, paying higher taxes, which might not have been or was unavoidable. Any quick questions on Amazon? Yeah.
How does Amazon look today? If you looked at their 2011 report, are they better?
Actually, 2011, their net profit margins were like closer to 1% instead of 3.3%. They've been extremely aggressive on doing things to generate sales at the expense of giving up margins. So no, I'd have to say it looks worse rather than better. Questions? We need to move to the next presentation if we can. I hope you either have read or will read Learn the Lingo Basic Ratios from Morningstar, because we're going to be, I'm not going to go through it like I've gone through all the rest of them. I will, over the course of the next, all of our rest of our sections, I'll be talking about a lot of those ratios and even a few tonight, but I'd prefer to take the time we have to start with just a couple ratios or numbers that's going to really help you get going in the beginning. And I'm going to call this module Stock Decision Making Basic Building Blocks. So first thing we'd like to look at is sales growth. This is a great base to start with. And why do we look at sales growth rather than earnings growth? Well, as you will dig into companies, you will see that most companies' sales growth is actually much more consistent over time than their earnings growth. The earnings growth has a lot more moving parts and so can vary on growth rates from year to year, but the sales growth tends to be much more consistent. It doesn't mean it's exactly the same every year, but it comes a lot closer to drawing a straight line, so it's a lot easier to project. This is the equation, obviously. Future sales minus base sales divided by base sales gives you your growth rate. So, it depends on what time period you're looking at. If you're looking at what the rate has been for the last 10 years, then you'd use current sales as what's shown here as future, and 10 years ago would be your base. Sales growth answers the question, is the company growing? Next, we need net profit margin, which is net profits divided by sales. This is going to tell us, is the company profitable? And finally, we have PE, price to earnings, and it is stock price divided by earnings per share. And this helps us understand what a good value for the company is. With these three pieces of information, we can do a lot. Before we go further, though, I want to stop for a second on PE and just there's one of my favorite analogies around PEs is comparing it to how we do things at the grocery store. So when we go into the grocery store to buy a hamburger, we look at the price per pound. And on days when the grocer's got a sale at $2 a pound, we load the entire cart up, stuff the freezer. But then a couple weeks later when we go back, we feel happy that we stuffed our freezer at $2 per pound because now there's a shortage and hamburger has jumped up to $5 per pound. And we say, we'll pass because we've got a freezer full and who wants to pay $5 a pound? Well, PE is to investing as price per pound is to hamburger. PE tells us what we are paying for $1 of earnings. And just like there are different cuts of meats, so we'll pay more for a steak than we will for hamburger, so is it true that some companies command a higher PE and still be a good value than a company with a lower PE. All right, so we talked about our three building blocks. Now let's look at our mathematical model. So first, future earnings is going to equal our current sales times, and I've abbreviated sales growth as SG, and I've abbreviated our net profit margin as NPM. So current sales times sales growth times net profit margin divided by shares. Once we have our future stock price, or excuse me, once we have our future earnings per share, we can get our future stock price by multiplying earnings per share times PE. So there's our three building blocks. I guess our pyramid's upside down. And then we can decide or calculate our stock appreciation. So we can take our future stock price divided by our current stock price, and we know how much we can expect the price to go up over whatever time period we're looking at. Pretty simple model. Let's go through an example. This is for McDonald's. Most of this data is coming from Morningstar, and I'm hoping we'll have some time at the end of this to go out and demonstrate Morningstar a little bit for you to see how it works. Okay, so let's remind ourselves, what do I need to have? So some actual numbers that I need is the current sales, and we want the trailing 12 months. That's what TTM stands for. We want the actual shares outstanding, and we want the diluted because they're more conservative. And then I'm going to come up with estimates on sales growth, future net profit margin, and future PE. And if I want to get a little sophisticated, I can also estimate future shares. Or if I want to simplify it, I can just use today's shares. This is somewhat a function of what kind of time frame I'm trying to project. If I'm trying to project a price for next year, you're probably all right using current shares. If you're trying to go out 5 years, then you may want to try and estimate shares because obviously there could be a bigger change in the shares over a 5-year period. All right, so let's start with sales growth, SG. And this is Morningstar's data. We're under key ratios and growth. And I like to look at the 5-year average line, and you can see McDonald's used to be 6 and then actually got up into close to 8% or over 8, and it's come down a little bit in the last few years. Now this is a 5-year average, so it's kind of a slow changing number. And you can see for the last 5 years through 2011 they were at 4.5%. Range of kind of 3.3% to 8%. Looks to me like the average might be kind of about 5, but I don't have to guess, as I can go over to, and here's a good place, you could go over to Yahoo Finance, and they'll tell you that the analysts think the sales growth for next year for McDonald's is 5.3%. Well, that seems pretty consistent with what my history looks like, so I think I'll use that number. Now let's go to net profit margin. Again, we're going to look at Morningstar, and I was going to mask who this was, but the big Fortune 500 fast food is in fact McDonald's. Under the key ratios profitability, I can see my net margin, and you can see it's varied quite a bit. Back in the early part of the 2000s, it was under 10%. Then they started building nicely, and for the last 3 years they've been very consistent at over a 20% net margin. And in fact, it looks to me like I might want to use maybe like 20.5%. And finally, our price to earnings, PE. Again, we go to Morningstar, and this is under valuation and price to earnings, and we get a nice little graph. McDonald's is the blue bar, and the S&P 500 is the orange bar, so we can see how it compares. And looking at the last 4 years, and why did I go 4? Well, I didn't like this 30 in 2007. That seems like a real outlier, which I could just drop it and go back and add a 2006 or something. But I just took the last 4 years, and you can see our average PE for the last 4 years has been about 17. Now we got to pick up our current sales and shares. These are actual numbers and not guesses. And so again, I'm on the financials tab at Morningstar, and I have a revenues line. It shows me for the last 5 years, and there's my trailing 12-month revenue is $27.5 billion of Big Macs. And on this same page on financials, I can also pick up my number of diluted shares outstanding, and that would be just a little over 1 billion shares. Okay, so we've got all of our numbers. Sales at $27.5 billion, shares outstanding a little over 1 billion. Sales growth, oops, that's typed wrong. We'll fix that on the fly. So 5.3%, we got that from Yahoo. And our net profit margin is 20.5%. And we think a good average PE is 17. And we're just going to use today's shares. So we've got everything need to do the math. So first we're going to calculate our future earnings per share. So that's our current sales times our sales growth rate times our net profit margin divided by shares. That tells us that a year from now we expect to make $5.75. We can take that future earnings per share, multiply it times our PE, which is 17, and it tells us that a year from now we expect McDonald's share to be $97.70. And now we can calculate a stock appreciation. So we take our future stock price and divide it by our current stock price, which today it was about $93.70. And we can see that based on our assumptions, we would assume that we might see about a 4% appreciation on McDonald's price today. That's probably something that's not going to get most of us excited. But different judgments will give very different results. So for instance, if you decided you thought for the next year their sales growth was going to be 6% and that they were going to get a little fatter margin of 21%, and that you think they're going to do a PE of 18, then instead of a 4% appreciation, you would actually have a 14% appreciation. So the judgments make all the difference in the world, and there is no right answer because nobody knows what the future holds. But what it's all about is learning how to make good judgments and testing them against what actually happens.
So which of those guesses is the most, I mean, that's a big change, 4% to 14%. So of these three changes you made, which one least likely?
The two that probably had the biggest impact were the net profit margin, because 0.5% on your profit margin is a pretty substantial increase, and the PE going from 17 to 18 is also pretty dramatic. So it's probably about 1 to 2% from sales growth, and these two are probably both 5 to 6% of the increase, or I guess we've got 10 total, so maybe it's 1 to 2 here and 4% for each of these.
For a large cap stock, are we looking at a PE ratio usually around 15? Is that an ideal PE ratio to where it's not overvalued or undervalued?
Yeah, we're going to spend a lot of time talking about PEs and how to know when it's a good and when it's bad. But yes, in general, on the broad market and large cap stocks, PEs in kind of the 15, 16 range is kind of mid-range. When they get closer to 10, it's extremely low. When they get up into the 20, it's starting to get nosebleed range. So it's not a bad rule of thumb, but like I said, we will spend a lot more time talking about PEs and also PEG, PE to growth ratio. But I think this model is going to be useful for this week's exercise.
Can I ask a question?
Sure.
What you do, take what you did and go backwards 10 years. So that you're making the predictions for 10 years in a row. And then and then you look at actual appreciation. So, let's say 2010, the actual appreciation was 6%, you predicted 4%.
Right.
And 2008, it was this, and then you predicted that.
Right.
From that, you get a running average of what would be a good way of handling Walmart stock in predicting the future performance.
Yeah, what you will find is stock appreciation will in fact match growth of the business over a long period of time, the return on assets, if you will. And so if you did this for every stock and did it for different periods, you would find large variation year to year, but the longer periods you looked at and the more you average them, you'd find that it matches extremely well. There isn't anything magical about this, and so it is in fact going to have very tight correlation.
You may not want to get into it, Paul, but you said if you want to dig deeper, you could estimate future shares. How would you go about doing that?
Well, that's a good question. Let's go back here real quickly. And so when we look at Morningstar, it shows us the shares over time for each of the last 5 years. And what I would have noticed looking at just kind of the last 3 years is it looks like on average McDonald's is buying back roughly something like 25 million shares a year. And so and our trailing is at $1.33 billion. So if I was going to go out a year, I might just do a swag and say I think they'll continue to buy back 25 billion, and so I might be looking at $1.8 billion instead of $1.33 billion. So you can let the history teach you something, but you can also go and look at what the company has actually announced, because they will announce buyback programs. They'll tell you how many shares they're intending to buy and over what time frame. And so their announcements can also lead you to an understanding of what might happen, especially in the shorter range, like a year out. Okay, so if no other questions, this is this month's picks, and I'm calling this list Good Ships based on last week's sessions. And so we have a list of 7 companies that the investment clubs can pick from. Qualcomm, ticker QCOM, they're in the communications equipment industry. FactSet Research Systems, ticker FDS, they're in the information services industry. McDonald's is on the list, ticker MCD, they're in the fast food restaurant industry. Coach, this is for all the gals. That's sexist. I know they sell man purses these days. Ticker COH, they're in the retail special industry. Fastenal, ticker FAST, they're in the industrial wholesale industry. IBM, we all know what their ticker is. They're in computer systems. And then finally Walt Disney, ticker DIS, and they're in the entertainment industry. So next week is an investment club week. You as an investment club need to get together and try and decide, when and where you're going to meet, who's going to do what. And you have to decide which one or two of the companies in this list you want to invest in. Selections are due to Josh before our October 1st CEOs roundtable discussion. If you pick two companies, you need to include what percentage you want to invest in each. If you don't include that, it will be a 50-50 split. I will buy the stocks in the clubs on the open price on October 2nd. We will put this list out as a sheet that you can refer to from the CEO's homepage under the schedule and resources.
Paul, give me a question.
Uh-huh.
I have a quick question. What happens if we decide not to reinvest and just keep the stocks we have currently?
No.
Can't do that?
No. This whole exercise is intended to teach you about investing, so every month you will invest in a company with the funds because we want to see real investments made, and you know, you may think it's not the best time to buy, and it may not be the best time to buy, but you're buying at the same time everybody else is buying too, so the relative valuations is also appropriate. And if the market goes down, if you've picked the right stocks, there's a good chance the right stocks won't go down by as much as the market.
So if we at the end of the how are we being evaluated? Is it based on overall like how much you're making or you're not making? Like how does this work? Because I know there's commission fees and everything.
It's going to be an annualized percent return based on all the investments made, and it'll be based on the money that you had. And so every investment club is getting $100 for each person. You are always getting fully invested, and so there isn't anybody sitting in cash in any way, shape, or form. Towards the end of the year, we may look at allowing you to sell a company and reinvest it in something else, but we're not going to do that until we get closer to the end.
Just so everybody knows, the old guard's making their move this week. Okay? Paul, you kind of made it sound like we weren't doing so good. In fact, it's all part of our strategy.
Strategy?
We have strategy.
Come from the hospital with the mass victory.
Yeah. So anyway, just want everybody to take your best shot.
How long have you been
I got another 20 years to go.
Exactly.
That's right. Kick his walker out. He'll be done. Any other questions on the exercise?
We're ready to do it.
Everybody is, or almost everybody, we've still got a few I've got to sort out, but almost everybody is now a member of the individual investment clubs. So if we go to Orange, you can now go here and look at accounting and see what your investments are. You can see who your members are. But the main thing, and these are going to get corrected. Some of the old guard are showing up in the clubs. We're going to pull those out. But there will be 3 resources in each of the individual clubs. Tom, my nephew, Lori, and I will be in all 3. But the main thing I wanted to point out is you can now send email messages to your club. So if you're part of Orange, you can send an email message to orange at bivio.com, and that'll go out to everybody in your investment club. So for communicating and setting up meetings and talking about what you're doing, all you have to do is send it to your club name. Pistol Pete's got an underscore, Old Guard's got an underscore instead of the space. All right, let's go to, I think I've got just a few minutes. If we go to Morningstar, anybody got a company they want to look at?
Yeah, well, Qualcomm.
Well, now let's we aren't going to cheat and look at the ones that are already up there. Let's look at Dell. All right, so I put in the ticker at the top, And this is where we've got key ratios. And that's where, under the key ratios, I actually get a little bit of the financials. Like there are my revenues, trailing 12 month. Here are my shares. If I go down to profitability, then here's my net margin line for Dell. If I go to growth, I can look at my revenue growth averaged by 3 years, 5 years, 10 years, year over year. Okay, so let's go back. So under key ratios, we get a little bit of financials here as well as under financials. There I can pick up my revenue trailing 12 month. I can pick up my shares for the trailing 12 months. And under profitability, I can get my net margin. So Dell's margin for the last 12 months was 5%. And I can go here and look at growth and get historical growth. So 3-year average, 5-year average, year over year. And you can see ever since, what, about 2007, Dell's growth has dropped off of a cliff, including 2010 when it was down by 13%. So Dell's clearly struggling. Dell could not be called a growth stock at this point. Now, if you Google Yahoo Finance, and we put in Dell, then right down here on the side is Analysts estimates. Oops. So I clicked on Analysts estimates, and we can see our revenue estimates, sales growth for the next year. They're assuming Dell's growth for the next year is less than 0.5%. And we're sitting really close to 6 o'clock. Do we have any other questions?
Oh, I just had a question. Lori sent out an email about a webinar tonight, TEFAS or something like that?
Yeah, tonight at 7:30 your time, there is a free webinar being done by Trefis. That's Trefis. It's a really interesting site. It was part of what I talked about at the end last week when a lot of you couldn't hang around. It is a website that tries to do bottom-up analysis on companies looking at core components. Let's see, real quickly, if we go to Trefis. By the way, the coolest thing about it is it's being done by a bunch of, it was started by a bunch of chemical engineers. So for no other reason, it's got to be good, right? Okay, so I put in Disney, and quickly Trefis tells me that 44% of Disney comes from ESPN channels, 15% from Disney Channel and others, 13.5% from Parks and Resorts, less than 10% from ABC Broadcasting, and less than 10% for Disney Studios. As a real interesting one, let's do Apple. We should see a real similar thing that yeah, so here's 56% of Apple is from iPhone, 12% is from iPad, a little over 10% from Macintosh, 3% from iTunes and apps, less than 1% from iPod, even smaller for Apple TV, and then they've got 17.5% of their value is cash. Anyway, the webinar tonight's going to tell you all about Trefis and how to use it. It's a free site to use, and it doesn't have all companies. I haven't even checked it to see if the 7 companies I gave you are all in Trefis. Some of them probably are, but probably not all of them. But it's definitely worth taking a look. If you click on any single item like the iPhone, it'll tell you the individual components like the pricing itself, what iPhone's market share is in mobile phones. The line here tells you where it actually was. So at the end of, right now it's at 7%, And in their model, they're expecting iPhone market share to go to 15%. If you don't like that, you just drag it and you say, nah, I think maybe it's only going to 8%. Oops, now Apple's only worth $525 instead of $700. So that's how quickly you can play with assumptions. I think that 2.8 million global smartphones are going to be sold, so Apple's up to 563. iPhone's gross profit margin, I think it's going to sink, and 5 years out or 10 years out, what is it? 10 years out, I think it's going to be down to 30%. Now Apple's value is only $512. Real interesting model to play with, real easy to do. If you register, and I don't remember if this one costs, you can actually look at other people's estimates to see what, how they'd change the model versus the model that Trefis itself has. Anyway, thanks for asking that. Trefis is really cool. If you've got time, I'd highly encourage you looking at it. It's, if not now, then in the future when you have time, go check out the website because it's got some powerful, powerful stuff. And at this point, Mr. Whiteley, I'm 3 minutes over time. So.
Good session. Good job. See you next week.
Appreciate it. And so next week is Investment Club Week, and then the October 1st will be our first CEOs Roundtable, and I will be back live for that to chair that. That's going to be an open. That's going to be an open forum discussion where we just talk about what you learned during your Investment Club Week.
All next week is October 1st.
Oh, I'm sorry. Next week is Investment Club Week, and October 8th is when I'm back and will be the CEOs Roundtable.
Okay, so we are or are not meeting next week? We are not, right?
We are not meeting as a big group. They should be meeting as small individual clubs.
Gotcha.
So I'm not going to be here next week.
No, so we'll be here 2 weeks from today.
Right. Night, everybody.